So I'd like to welcome everybody to the New York City Advisory Commission on Property Tax Reform. This is our second public meeting. We're going to have a presentation from the City Council staff to help educate all of us as we contemplate what kind of changes should be made, could be made to the property tax in New York City. And so we're really happy to have this meeting taking place in City Hall, in a building where the City Council actually works, where I worked for the City Council like 25, 30 years ago. So the place has gotten a lot nicer. So this is, it's wonderful to come back. So I think we're going to go around the room, introduce ourselves, and we'll start over here so we end over there so Ray can introduce the panel.
Good morning. I'm Michael Hyman from the New York City Department of Finance, sitting in for Jack Jiha.
I'm Francesco Brindisi, representing the Director for the Office of Management and Budget.
LaTanya McKinney, City Council Finance Director.
Alan Capelli, Commission Member.
Carol O'Claricon, Commission Member.
Mark Shaw, Co-Chair.
Vicky Bean, Co-Chair.
Ken Knuckles, Commissioner.
Good morning, Elizabeth Velez, Commissioner.
James Parrott, Commissioner.
I'm Ray Majeski. I'm Deputy Director, Chief Economist, Council Finance, representing City Council. And I'd like to introduce our presenter today, Emra Dev. Emra is Assistant Director in the City Council Finance Division, and Emra leads our property tax team and does many other things. I think you'll find this to be both a very good and very useful presentation. Working with council members, Emra has developed, I think, a considerable facility in explaining a very complicated property tax and how it works. And I also wish to just take the moment to thank the rest of Revenue and Economics Unit, and particularly the property tax team, for their work on this presentation. Emra?
Thank you. Good morning. As Ray mentioned, my name is Emra Dev. I'm an Assistant Director in the City Council's Finance Division. I just want to start off by thanking, again, Ray, particularly for helping put together this presentation, but also the Revenue and Economics Unit and the Finance Division as a whole, led by LaTanya McKinney. I also want to thank the Commission members for allowing us the opportunity to present this today, and hopefully this will be informative and a bit illustrative in helping think through how to reform the property tax. A few caveats as well before I start. Everything I say here should not be taken as an opinion or representation of the City Council or any of its members. What we're presenting here is more of a technical briefing. We'll present some illustrative examples which should not be taken to be an opinion or a suggestion in any sort of way, but it's more to help understand how the system might work and how it's affected by various changes to it. So to kind of set the stage of what we're trying to do here today, this presentation builds off the presentation from the last commission meeting, which was an overview of the property tax as is. This kind of goes through the same overview, but through a different angle, and that's to look at how you can adjust the current system to enact various policy goals. So hopefully this will seem somewhat familiar from last time and help you understand sort of how those things might be changed. I also want to note this is not necessarily an exhaustive sort of presentation of all the levers you can think about and how you want to change the property tax, but more as a starting off point. So there may be levers that we don't necessarily address that we haven't thought of, that someone else might bring up at a public hearing, or that members of the commission or other experts out there might bring up. So with that started, we'll go into the second slide. So what do you mean by levers, or levers, depending on how you want to say it? I think we think about it, if you want to think about a tax, you can consider a tax in one way, which is that the tax is basically a formula where you have some sort of base that you want to tax, and you apply a rate to it. The levers are ways to shape that formula and adjust that equation to get to a certain policy goal. So for this commission, the charge from the mayor and the speaker of the council were ways to adjust the city's property tax to increase transparency, fairness, make it more simple, and do it in a revenue-neutral way. So there may be other considerations out there, but these are the main ones that we've gleaned from the communications of the mayor and the speaker. So just an overview of what we're going to look at here. This is a sort of a kind of a generalized overview of how the property tax works and sort of the various steps of it. You can apply levers at different steps of the process. There's no one place to put a lever. You might want to provide relief to some property owner. You can do that at various steps. And so I want you to kind of, as we go through this, think about how levers can be applied at different places to do the same goal. At the same time, sometimes you might find that there are levers that are doing the same thing at different points, or doing opposite things at different points, or at the same point. So sometimes you might enact a lever to do one thing, and then another lever gets enacted somewhere else down the line that undoes part of that, or changes the effect of that original lever. So it's important to consider that once you effect a lever in one place, other steps might have impacts on that. I will go through each of these points one by one through this presentation, and hopefully kind of explain how levers might be affected to address policy goals. So the first step is classification. We start with this one not because this is necessarily how the very beginning process of how you determine a tax, but it's a kind of a framework to think about how you might organize the tax. This is really an organizational lever. It's a way for us to think about how we might want to group properties in different categories and apply a set of treatments to one group of properties versus another one. How you define those groups is variable. It could be based on use, it could be based on size, such as the New York City one does. It could be based on age of the building. There are many varieties of that. So the question is then, if you want to group these properties, how do you treat them differently versus how do you treat them the same? And you'll see in various levers throughout, further on, that's where you kind of apply those different treatments. But the other consideration to have is when you do create classes, what are the relationship between the classes? You're effectively creating many property tax systems by creating classes. So in some ways the systems will be different, in some ways they'll be the same. What is the relationship between the systems? New York City, for example, their relationship is tied through the tax rate system, which we'll get to in a bit. So class 1 is related to class 2 through the rate system. New York City, you can also consider, for example, classification. It's not a requirement of a property tax system. There are systems out there that don't have any classes, that is just everyone's in one class and you apply the treatments equally. You might have variations, but there's no idea of classification. There are systems where you might put commercial property into one class and residential property into another class, so you have two classes. Ontario is an extreme example where they have 36 classes and subclasses of properties. Everything from shopping malls as one class, forests, agriculture, small residential, new development properties is another class. So that's one extreme. New York City has 4 classes, major classes, I should say. There are a few subclasses as well. This will sound familiar from Karen's presentation in July. These classes were developed in the 1970s and early 80s. Consideration here, lever consideration might be, do those classes make sense in the New York City of today? The city has changed, obviously, since the late 70s, early 80s. Maybe there's some difference there. Classes in New York City currently have different treatments and similar treatments based on assessment rules. You know that class 2 and class 4, for example, are assessed at the same ratio to full value. They have similar treatments and changes in assessments, but then class 1 has different treatments. There are different rates to each of the 4 classes. And as I noted earlier, each of these classes have different rates, and the rate system is what ties them together that kind of creates it as a unified system overall. I'm going to go through a bit. I know that might sound a bit confusing, but I'll go through a bit about this when I get to the rate system. So,
Emma, can I
yes,
ask one question about that? The four classes are set by state statute.
Yes.
So to change those four classes would require a change in the legislative
Correct.
ordering here. But the subclasses, how are the subclasses?
I believe they are also set in state law. I'm not gonna, I don't wanna, I don't have, I'm not a lawyer, so I don't, but my recollection is that they are also set in state statute.
Thank you.
And they have changed.
They have, right, exactly. So when the system was first set up, I believe, and let me walk that back a little bit. I'm not 100% sure, so I don't want to kind of give wrong information, but that's something to look into, sort of what has changed and what hasn't changed since that time. Any other questions on this slide? All right, let's move on.
I would just add, since I've been here, I've heard suggestions for one-class system, two-class system, three-class system, folding utilities in with other commercial properties, four-class system, and a five-class system. So there's been a range of suggestions discussed.
So the next set of levers are within the framework of value. What do we mean by the base of what we're taxing here? What do we mean by property? What exactly are we taxing? And when we think of that thing, how do we translate that item into a number that a value that we can tax, right? So this is a bit sort of out there, I realize, and I think I want to take a bit moment to walk through this. So think of a home, a one-family home. And it has 3 bedrooms. It's located around the corner from a train station, a subway station, 2,000 square feet in a certain neighborhood. You could think about what the value of that property is based on how much someone might be willing to pay for it on an open market, right? So that's, I think, an easy consideration for us to have. So if that value, let's say that value, we decide that value is about $1 million, right? That's just it's in a nice neighborhood. Now, think about what happens if the city decides to rezone that neighborhood and say, that property, you can now build a 30-story multifamily building on that lot. How does that affect the value of that property? Now you're thinking about, well, maybe the value of that property is more than $1 million because I can take that, I can tear it down, and I can build a multifamily residential building that is worth a lot more. I think it's important to think about then what value you want to use. Do you want to use the value, the first value that we're talking about, the value in the current use, the current structure? Or do you want to think about the full potential value that someone might pay in the market? How do you restrict that? You know, we think about the physical aspect of the property, but there's also the legal structure that the property exists within. What are the rights you have upon that property to adjust it, to use it? There are considerations around how legal restrictions such as rent stabilization might affect the value, current leases might affect the value, those kinds of things. I think going back to value, you'll recall in the DOF presentation back in July, their slide 7 went into a bit more about how they value income-producing properties. And in that, there was a note about how, and I'll just read the quote, projected cash flows are generally not included in mass appraisals. They're difficult to estimate for mass appraisal purposes, and courts have deemed them too speculative. Such anticipation of future appreciation is, however, reflected in sales prices. And those sales prices are used in the valuation of single-family and 2- and 3-family homes. So in effect, the city already has slightly different definitions of value for different types of property. The question is, should we use the same definition of value, different definitions of value? What are the implications of those different definitions of value? And how do we, when do you want them to be the same or different? So that's one lever, I think, to think about what we mean by value and what do we mean by property. Once you figured out that sort of theoretical thought process, then you come to how do you determine the value of this property? The property tax is different than other taxes, most other taxes, in that there isn't necessarily a transactive event that occurs that will give you a specific value for which you to tax. So you think about the sales tax. If I buy a pair of shoes for $120, the $120, that's the base of my value, and that's what I'm going to tax it on. Now, you may have some adjustments based on that, but there's an easy part to register there. The property tax is based on a theoretical idea of what the value will be in a certain context, whatever we're defining that to be. So how do you determine that value? It's a difficult process. I think my colleagues at the Department of Finance do a lot of very good work to value the over 1 million parcels of property every year. That's a lot of work to do, I think, and they've, over the years, have worked to improve that process. But you can think about what methodologies you might want to use. Again, back to the prior presentation, we heard about 3 major methodologies: comparable sales-based valuation, income-based valuation, and cost valuation. But then even within those methodologies, there are variations on how you do them. There may be levers there in how you use methodology to kind of get to that value. There are considerations about the data limitations you have around estimating these values. You know, we're creating an estimate. We have to kind of have information to help us make those estimations. So what sales do you use? We collect, for example, real property income and expense statements from income-producing properties, which helps provide a basis to value those properties. There are legal restrictions around how we can value, most notably with the co-ops and condos. Section 581A of the Real Property Tax Law of New York State requires that DOF value those properties as if they were not co-ops and condos, or in other words, as rentals. How does that affect the value, and how do we want to adjust that? Is that a good lever to use? Is it a bad lever? Are there other restrictions we want to place in there? And I also note in terms of valuing the base, you want to think about how to minimize inaccuracies. As I noted, these are estimates. When you're doing estimates, that's usually based on a statistical model, not always, but in any estimate, you're going to have some degree of error. That's not necessarily a bad thing, that's just the reality of the situation. The goal here is how do you minimize those errors? And there are several ways to think about that, and these are also levers to think about. You can improve the way you value those properties. So improve the methodologies, improve the data. What are steps that can be taken there? Hopefully give me 1 second. Another set of levers is, once you think about how you improve the process to create those values, how do you review what you came up with? How do you make sure that how do you know you're as accurate as possible? What does accuracy mean in this situation? And part of that is quality assurance, part of that is data reporting that others can do outside quality assurance, monitoring, data analysis, what levels of analysis are you using, what are the metrics you want to use to kind of view how something is accurate. And then there's the last part is the individual property owner and their ability to come back and sort of have a comment on the valuation. I mean, much of what we're talking about is mass appraisal, mass assessment, mass analysis, mass data analysis. We're talking about 1 million parcels of property. The appeals process is a moment for us to look at more granular level of how accurate something might be and see if there's anything idiosyncratic about that property that maybe affects the value. So again, that's another lever to think about how value might come into play. Right? Am I making sense here? Is this?
Well, I'd just like to, I don't know if it's ask a question or make a statement, but sure. I think one of the things that's different and special about the property tax is that all this information is public.
Yes.
You're dealing with other kinds of tax policy, like the income tax. All right? Individual information is not public. All of this is, and so that's, I guess, what I wanted to ask. Everything you've just been discussing, from air rights to all these other things that are maybe unique parts of commercial property, is all public information. Is that correct?
No.
Okay.
The RPIEs are
No,
not public.
I would say the results to a
results are
degree
public.
are in a general sense. I'm going to speak in generalities here. Just there might be this property tax system, as you will learn if you don't already know, is the exceptions prove the rule here. There are always, you can't make any blanket statements in a lot of ways, but I would say that the results tend to be public. Here's the market value of this property. Yes, you can go on the office website, look up that parcel of property, see what the value is.
Well,
how they got there.
The sales prices are public.
Transactive, yes, transactive sales are.
The actions are all public.
Right, but we don't know, for example, as Commissioner Bean mentioned, what the income and expense of that particular property is. DOF does report on the income and expense they use to value that property, the estimated income and expense, but the exact, if that property filed a real property income and expense statement, we don't have access to that data as the public.
Right, and there's also time lags in when you get the information, and I think that's that's another issue that we kind of have to deal with about the leads and lags, the time leads and lags in
Correct.
In doing the valuations.
Right, the data, which data are you using?
The data are not.
Right.
I would say, though, the Department of Finance does publish every year, when you get the notice of property value, kind of details on how the computations are done. As you said, like for comparable rentals are used, those are all published. So the RPIE is the main data that's confidential.
I believe that's the only one that's confidential.
Right, yeah.
Everything else is public.
Yeah. And that's what I wanted people to,
Correct.
okay.
So I will touch on this a little bit later too, about this level of what can be public and what shouldn't be public in terms of data. But also the methodologies that DOF use, the surface is there, but to some degree, the real detailed methodology is not necessarily public. And there are reasons for that. We'll get into that in a little bit, but I just wanted to, yes, unlike like the income tax, there's more public here than there are for other taxes.
I want to take us back to the base. In looking at the base, what you emphasized is, the city mostly uses the current, treats property by its current use, though with the exception of vacant land. And there are a lot of other places that do highest and best use as an alternative for valuation. But there is something even more basic.
Could you repeat what you said at the beginning, Ray?
For most purposes, and please correct me, Mike, if I've gone wrong on this, the city uses the current use of the property when looking at the value of things, with the exception of vacant land, which it treats by the best use, the highest and best use. But there are other places that look at all property through highest and best use. So that's something to think about. That has ups and downs for the city. So it's not. But the other thing more basic is what we tax. With the property tax, we tax land and we tax the improvement of land. Now, there are places that just tax land, which in New York City would mean the location, right? And, from that's the whole Henry George thing, and I'm sure somebody will come in to talk to us about the virtues of a pure land tax. So we can think about shifting the whole thing onto the value of location. There's some economic reasons why that's good, some administrative reasons why that's a headache. On the other hand, there are places that also tax, I haven't looked at this much, but also go further. They tax land, the improvement, and certain kinds of personal property rather than just real property. So once again, that's another system that just looks at the base that we also could consider.
I would just add that, that's a valid point, but when you look at methodologies, when you use best use, you also have methodological issues. I mean, one of the issues when you're doing mass appraisal, if you're kind of projecting forward, you have to look at things like discounted cash flow, and using, often there's not enough cells to actually do a cells-based valuation method for certain types of properties, like commercial properties. So, these are trade-offs. There are issues of current use, best use, but then methodologically there's issues of what produces the most valid and horizontal equity result.
So who decides what is in the base? So for example, air rights, right?
Thank you.
Who decides that we don't tax air rights or we do tax air rights? Is that a definition by state law, or
I think it is a definition by law. So yes, it is a state law issue. So air rights, for example, are subject to transfer taxes if you trade an air right. but they're not part of the base of what's in the property tax system. And as Ray says, some jurisdictions do include personal property, but often they have kind of default provisions that, you know, you have a safe harbor. You can say my value is worth X, and then they don't actually assess the personal property. It's more like they have classifications, and it's kind of plug numbers. I think jurisdictions in general are kind of moving away from personal property. But the real property questions he raises, I think it's going to be an issue for this group: methodology, what's included, air rights versus other things, and then the issue of, you know, the trade-offs of how do you, I mean, the data collection is essential, and the best data is current use. So once you get into future use, it's a valid point. You might want to look at it. It just becomes a little more speculative.
So when air rights are transferred from one property to another, it does nothing to the property tax of the parcel that it got transferred from or to. It's only when those air rights are used to actually build something that it turns into something
That's correct. We don't tax the development right per se. Undeveloped is not part of the real property tax system.
So is that a sales tax that's imposed on a transfer of air rights?
The transfers are subject to the one-time real property transfer tax, but it's not part of the ongoing property tax system. It's only as the co-chair, when it's developed, that it becomes. And there's zoning issues of how you develop air rights. That's a hot issue now. You know, buildings on top of buildings, things like that. There are rules that we don't allow a totally separate owned building to be built on top of another building. So that's a hot issue. It has to be merged or has to become a condominium.
Not to digress unduly, but how do you compute the transfer tax?
The transfer tax it's kind of like an excise tax. It's the value of the transfer times the tax rate. So if it's a commercial, I think it's over 3% now.
Okay.
Can I pursue that just one step further? For commercial building, or any building that allows a billboard or uses billboards or uses the whole, or the issue of signage, and I assume that is, I don't know, so I'm asking the question. I assume that that's like an extra lease, and that's just going in the RPI, that we have no way of having data, separate data on how much this generates and where it generates and how much it's governed by law or not.
Well, it's part of the income and expense form, and landlord is supposed to report the type of income.
But is that governed by zoning?
The zoning is the underlying issue of the usage, and if it's done, then the property tax is...
Whether you can have something on the side of your building, is that...
Yeah, that's a zoning issue.
Zoning issue, it's a zoning issue, okay.
Hasn't always been enforced in the city, but it's a zoning.
Okay.
I beg your pardon.
So it's getting taxed into the value of the building by whatever income it's generating.
Exactly.
Great, okay, thanks.
So are there other, I mean, air rights are obviously an issue in terms of whether they should be included, and that's a discussion that's going on around the city. Are there other controversies over what should be added to the base that we should know about?
I think for real property tax purposes, you know, the issue becomes more the valuation of land versus the improvement. Generally, all real property is part of the base. I mean, the utility tax has issues that personal property is subject to the utility tax, so that's one thing that can be viewed. But I think in general, I mean, there may be issues of land underwater, those kind of issues, but I think for most, you know, land and the improvements on it are part of the real property tax base. The issue becomes treatment of various components, and as the presentation is saying, the, you know, inter-class dimension to it.
But it shows up in the value of a sale, is when you first see it, right? So, I mean, sort of a different version of value capture.
But you raised the issue, or somebody raised the issue, you did, Ray, I think, of personal property tax. And my experience in other places is in places that have large amounts of industrial use property, then the personal property tax gets at machinery, and it could, I guess, in the 21st century, get at technology. And you could take, I guess, some information based companies and their real estate, and tax also their personal property, if personal property were in the form of I don't know, servers and data mining exercises. I don't know if it's done anywhere, but I'm just raising it because personal property relates to a different part of the economy. It's just that it hasn't been a big base in the New York City economy in our in our lifetime, but it was in previous lifetimes.
Right, it's the whole issue underneath the utility, class 3.
Yes,
for
yes.
what used to be railroad properties and the improvements on them, as well as telegraph and telephone.
Exactly, and now what ought to be considered a utility.
Right.
Yeah.
One last question, at least from me on this. When a property is, let's say, reserved for affordable housing, is it taxed as, in terms of its value as affordable housing? Or is it taxed as its value as housing in general, without limitation?
I mean, it's generally still subject to income and expense rules, although the affordable, we do get from like HPD information on which units are affordable, so often the income and expenses reflect that. But it's not like there's a legal separation, it's more just the economics of the building determines the value. But that's an issue that can be explored, whether or not there should be more targeted.
And the question of whether or not those affordability restrictions expire is calculated in or not? It's not, if it's just income and
It's just generally
expense.
based the income and expense flow at a given point of time. As we're saying, we get the income and expense statements, they're lagged by, so we'll receive them in June of this year for the prior calendar year. And then the information gets adjusted going forward, and what we publish are the adjusted numbers that you can see on anyone's notice of property value.
All right. I guess we're
Sorry.
no, this presentation is working. It's sparking conversation and discussion about these different levers here, so that's good. So now you've done the difficult process of determining what it is you want to tax, how you want to define that, how you're going to determine that value and make sure it's as accurate as you want it to be. Then you may want to adjust that value for tax purposes. This is an area where I think often policymakers kind of focus on the property tax, and so this will seem a bit more familiar, but currently our system has two major flavors of adjustments to the value for tax purposes. The first is assessment rules, and the second one is exemptions. So assessment rules these are endemic to the property. As we mentioned earlier, the classification of property into 4 classes, and then there are also subclasses. These will affect these assessment rules. So the first of these is the fractional, and by endemic I mean that the owner doesn't have to take any action, it's just based on the property demographic itself. The first assessment rule is the concept of fractional assessment. So in New York City, we do not tax at the full value of the property. We take a fraction of that value, and that's the assessed value. For Class 1 properties, that's supposed to be 6% of a property. For all other properties, that's 45% of the full value. These fractions are determined by the Commissioner of Finance. You can change them on an annual basis, though by nature they usually stay put, and they've been changed several times though in the past that I can think of. The next aspect to these assessment rules is that there are growth limits on how fast those fractionalized assessments can grow. You'll recall that there are caps on small residential properties. They cannot, for example, a Class 1, 2, and 3 family home cannot see its assessment grow more than 6% in any 1 year or 20% in any 5-year period. Similarly, for 4 to 10 unit residential properties, those caps are 8 and 30%. All other properties except for utilities see their changes in assessed value phased in over a 5-year period. And then with a few small exceptions, these caps and phase-ins don't apply to changes in assessments that are caused by physical changes. So if you construct a new building and the value increases, the assessment increase will not be covered by those caps. So some of the levers here are to think about fractional assessments. Do they make sense? Is that thinking about from the transparency angle, the equity angle, the fairness angle? Maybe this is a method to sort of allow us to do these assessment growth limits and play around with those separate from the value. So maybe it's a sort of a thought process division here. These growth limits levers here are these the right kind of growth limits? So should they be expanded, reduced, adjusted. There are questions, for example, there have been suggestions in the past about allowing assessments to reset upon sale, upon transfer of title, for example. There have been suggestions of moving these caps to more of an exemption-based model, which I'll get to in a second. There have been, in the past, the city has gone to the state to ask for legislation around the physical improvement limits, or the carve-out for physical improvements for properties that are rebuilding after a disaster, most notably Superstorm Sandy. There have been issues around physical improvements in gentrifying neighborhoods. One of the other exemptions is carve-out. So this carve-out is small Class 2 properties. Their physical improvements come in at 1/3 of the value that a regular Class 2 would be. And there's a history on that. I don't want to get into too much detail on that, but there are ways to kind of play around with these levers. So what is the right kind of limit you want to apply to a property, irrespective of its ownership? Exemptions, on the other hand, do look at the ownership of the property and what that owner does. So an exemption also reduces the value that's taxable, but unlike an assessment rule, this requires the owner to take some sort of action. They have to apply to DOF or the state, and they have to meet some set of criteria, right? So maybe the most basic one of these might be the STAR exemption, where this is a state program where you are you have a residential property and it is your primary residence. You will get a small tax break on that. These exemptions come in all flavors. They are here often to provide relief to low-income homeowners or homeowners that we deem as a city and as a state to be worthy of relief. They are designed to encourage development, things like 421A and ICAAP for the commercial properties, or they might be there to address some sort of policy failure, and I should use failure should be in quotes there. I don't want to say it's that a failure by the government to act well, but it might be to help undo, maybe we have some other policy that has some negative impacts on the taxes that we want to kind of even out a little bit. So, or it might be something like the co-op condo abatement, which was put in place in 1996 as a result of the prior Property Tax Commission as a way to equalize the tax burden between Class 1 homeowners and co-op and condo homeowners. So there are various reasons why you might have exemptions. That's actually an abatement. I don't want to confuse you there, but that's, so then the question here is, these exemptions, we need to note that, for example, the City Council a few years ago began a process to review these exemptions for economic development purposes and to evaluate them on an annual basis in conjunction with the IBO and working with the Department of Finance and the Economic Development Corporation. The other exemptions are not going to be reviewed necessarily in that sort of framework yet. Maybe one lever might be to review those other exemptions. There might be a question of how well these exemptions meet the policy goals of the city. Are they doing what we intend them to do? So there's some levers here between assessment rules and exemptions. Back of the envelope about the city currently reduces, the city's property tax system reduces values by about 25% under both of these areas, between exemptions and assessment rules. That doesn't necessarily mean that everyone is paying 25% lower. It just has a redistributive effect to some degree, I think, in a revenue neutral system. But so the question is now, did this structure make sense to what we're trying to do here?
Can I ask a question?
Sure.
So do the owners of educational institutions and hospitals that are eligible for a charitable deduction, do they apply for exemptions?
Yes, so the state law around charitable deduction, the property tax exemption for not-for-profits requires that the property be used for an eligible use. It's not that it simply be owned by not-for-profit. And part of what Department of Finance requires, and I'll let Department of Finance answer this more specifically, but they do ask that these charitable property owners show that they're using it for that charitable use to give that tax break under state law.
In the case of hospitals, I'm curious what the institutions have to show or indicate to the city in order to retain that exemption.
Well, it's somewhat a product of state law. We're not automatically linked to the federal exemption status, although often the 501c statement can serve as corroboration. So there are state law requirements that require it to be for charitable education. It's not the full panoply of 501c categories. It's more strictly charitable or educational, but even those, they do apply to the Department of Finance. We're in the process of trying to streamline some of those processes, but we do have to follow the state law requirements, and they do have to be renewed periodically. So part of the issue is the upfront documentation can include a 501c, but it has to also include stuff that's specific to the state law, especially the issue of usage. It has to be used by the recipient of the exemption. It can't be rented out to another party.
But to follow up on James' point, though, in the case of a hospital, for instance, where it has the exemption because it's used as a hospital, when a portion of it gets used as a restaurant, for instance, how do you deal with the tax?
Well, you can get a partial exemption. So the part that meets the qualifications can be qualified for the exemption. The other part would be subject to taxation.
And is that something you guys review on a regular basis, or is it something that they apply for when they're changing the use of a building?
Well, we currently, to be in compliance with the law, we do require annual renewals, and we are looking at, and people are supposed to self-report that information, and then a lot of the renewal effort is really just the outreach to make sure everyone's cognizant and is actually sending in the renewal forms, because we've been over backwards not to revoke a benefit if we think people deserve it. But in those mixed-use areas, that's fairly typical, that you'll have a building that's partially owned and operated by a nonprofit, and part of the building may be used for a restaurant or a taxable purpose, and that would be taxable.
In the case of hospitals, though, if you have a hospital that has a doctor's practice that's affiliated with the hospital, and the doctor's practice operates out of the hospital, operates out of the building that the hospital owns, is that doctor's practice also tax exempt?
And there are nuances. I don't want to give incorrect information. I mean, the general principle is that for private practice is taxable, but if you give me different scenarios, I can make sure I give you correct information back.
And just to follow up on that, the definition of what is a charitable purpose is in the state law? So if a hospital is not treating any persons in poor people, or it's just treating, it's a concierge practice, for example?
There are state law provisions that define the kind of purposes that are qualified, and it's generally the charitable, educational. A hospital generally qualifies, but it's not like we can take the federal certification alone as justification. Often, this federal 501c is sufficient, but we also have to make sure that it meets the other criteria of the law. But they are state law defined.
Some of it's actually state constitution versus state law. Also.
Yeah.
Okay, great.
All right. So the other thing, one other consideration about this is in a revenue neutral reform environment, the other consideration to have here is if you're adjusting the value downwards or upwards for one group of people, if you, for example, if you exempt everyone by 25%, that doesn't mean everyone pays 25% less in a revenue neutral scenario. You have to make up that money, and so it comes back. So if you're providing a break in one area and providing a break in another area and another area and another area, eventually giving everyone a break, it's not that break on, you have to think about it in a relationship sense. So I think there's part of the calculus here is going to be thinking about the relative breaks between different properties as well.
And it also affects class shares.
Yes, which we will, yes.
So does that concept work both ways? If you come up with something that increases it, that you can lower everything else?
Yes, I mean, if we're working in the framework of a revenue neutral environment, which is what the charge is here, yes, that would follow. So now we've figured out the value of the property, what that means. We've adjusted it to meet certain policy goals for various reasons. Now we need to apply a rate to that taxable value that we have. The question here is now that rate is going to be there. The question is, do you want to vary that rate based on some set of criteria? Should everyone be taxed at the same rate? You know, obviously, for example, you can think about the income tax on the federal level and the state level have a sense of progressivity where higher incomed peoples and individuals and taxpayers pay a higher rate. So if you do, what is the intent of that variation? How do you define that difference? You know, in our system, for example, we use it. There's a variation on class. You know, each of the classes pays a different rate. But even within that structure, there have been variations for that class's rate. So I'll give two examples. Up until recently, the veterans exemption had a rate change as well, embedded in it. So the way that exemption used to work was you had a veteran who had a home and they got an exempted value, let's say 10%, I can't remember exactly off the top of my head, but 10% of that value was an exemption, right? And that value, unlike other exemptions, was not fully free from taxation. They had to pay a mini tax, in a sense, on that exempted value. That was known as a school rate. So instead of paying the full, say, 20% of the Class 1 property tax rate, the owner had to pay a 12% rate on that exempted value. So it's still a savings, but it's not quite the same way as it would be for a senior homeowner, citizen homeowner exemption. So you can have smaller rates for certain types of properties or certain types of parts of the value. The city also has over a decade ago, looked at putting together a surcharge on what they called absentee landlord properties. These were Class 1 homes, 1, 2, 3 family homes that were not owner occupied. This surcharge never went into place and got actually mothballed before it went into effect. But you can see that the idea of putting say, a 25% surcharge on the property tax rate on a specific group of properties for a policy goal was considered as well. So there might be opportunities or instances where you might want to vary the rate for policy goals or for these different classes.
You're saying you don't, it was passed, but it's not in effect?
Yes, it's been zeroed out so the state, the city, and I don't want to get too much into sort of the history of that. I think that can be discussed, but I was not here for that, so I don't know. I don't want to speak to that too much. But
I don't either, and I don't want to. I'm not sure this is the right meeting to do it, but at some point, I think one of the criteria by which we have to judge our suggestions is the practicality, the enforceability, the administratability of something. So I'm just curious as to whether this was mothballed because it proved to be unmanageable or unworkable, or was for some other reason.
I think just since I was there when this happened, it was a combination of some reluctance on the part of Department of Finance involving it because, administering it, in some ways it's just the opposite of doing something like STAR, right? That, you have abatement, you have special treatment for owner-occupiers. Well, this is just the reverse. But they, at the time, were uncomfortable with the idea because they felt that it was very different giving somebody a break because they were an owner-occupier and giving somebody an extra fee because they weren't. They thought that and that it required a much more difficult, I think, administrative effort on it. There also was some political side to it involving, well, I won't get into the political side on the record, but off the record we can talk. Okay.
But I really wanted to press the administrability issues, because those are issues we're going to have to take on.
Yeah, right? And this was a fight between DOF and Council Finance about whether it was administrable.
Yeah.
I think
Could I
that should
just
be.
ask, is the veterans tax that you referred to earlier, is that still?
So, I believe last summer, the state had authorized the city to adjust that exemption to make it fully tax exempt. So now the veterans exemption follows the metrics of follows the framework of other tax exemptions where the veterans exempted value is fully exempt and there is no mini tax on that exempted value.
So it, in a sense, increased the veterans exemptions value.
Yes.
Right.
I would just say generally on the administrable issue, which I think this commission should look into, part of it is the practicality of the underlying definitions of what you're looking to for the source of the information. For exemptions in general, when you have it income-based, I mean, there's issues of trying to get to gross income because it's nice economically, but it doesn't tie into any of the information. To the extent that you can tie into information on a personal income tax return, on a 1099, it makes it much more administrable.
So then, let's say we've figured out how we might want to vary the tax between different types of properties, for whatever reason it may be. Keep the one we have now or some other system. Then there's a consideration, well, how do you determine what those rates are? Do you allow the city to say, all right, I want to tax class 1 at this rate, and I want to tax class 2 at this rate, and class 3 at this rate, and so on? Or do you set up a system that is based on some other kind of goal other than direct rate setting, which is what we currently have now? So I'm going to spend a little time walking through our tax rate system. I'm going to try to kind of walk this through in a hopefully illustrative way that hopefully makes this a little bit more transparent for the members of the commission. I understand this can be a little confusing, so hopefully, please let me know if you have questions as I go through this. But the current system does not allow the city to set any of the individual rates for the 4 classes of property. Rather, the city has the authority through the budgeting process to determine the overall levy of property taxation. That is currently set at a set rate, 12.283% or so, times the overall taxable value of the city. This, in effect, allows, kind of creates a strong relation between the property tax levy and the growth of taxable value in the city. So if the taxable value goes up 10%, the property tax levy goes up 10%. If the taxable value goes down 10%, the levy goes down 10%. Then that levy is used to determine the rates based on a formula set in state law. That's just sort of, and it's not a, there's practically no discretion in that formula whatsoever. Those 4 rates are, as I mentioned, they're related based on this formula. And the basis of that formula is that each class, class 1, 2, 3, and 4, pays a specific share of the overall levy, regardless of what happens to their taxable value, right? So, and that share is, I'm going to get into that in a little bit too, so that's just something to kind of keep in mind. So let me kind of break this down a little bit more here. Let me just kind of first actually show you what the class rates look like. This is a recent history of the tax rates. This starts from January 1st, 2009, midway through fiscal 2009, which is the last time the city adjusted the overall tax rate. The most obvious sort of outlier here is class 1. That rate has been going up over the past 9 years fairly steadily. But I also want to point out class 2 and class 4. These 2 classes in many ways are very similar, right? They are valued, particularly larger class 2s, in the same method. They are a net income capitalization method. They have the same assessment ratio and same assessment rules. I mean, I'm including small class 2s here, but the big part of class 2 is in has a similar treatment. Yet class 2 has a rate that's about 20% higher than class 4. So why do we tax multifamily residential property 20% higher than commercial property? It's a good question. So it's not about that decision-making. The lever here is not about setting these rates based on any particular reason here, but it's based on the system that determines these formulas. So, how do we do that? The rates, this is a very simplified equation of how we determine the class rates. This may seem familiar from what Karen went through a month and a half ago, where the rate for a class, let's say class 1, is equal to the total levy of the city. So if we say the levy is $100, take that levy, you multiply it by the class share, and that gives you your class's levy. So if the class, if we say that class 1 needs to pay 15% of the levy, which is about where we are now, and if the levy is $100, that means class 1 has to pay $15. Then you take the $15 and you divide by the class taxable value. How much value in that class you can tax. And so you distribute equally amongst that value. So if you say $15 needs to come from class 1, and let's say there's $30 of taxable value in class 1, then your rate has to be 50% to raise that value, right? So let's think about that a little bit more in terms of the context of what we've been doing so far. The total levy here, when we're talking about levers, is revenue neutral for the most part. There's a bit of variation there, but I'm just going to sort of work with me here on this. So since that's revenue neutral, there's no change in that levy. So you kind of think back to your algebra activities where you say, here's this equation, if I move this one way, then something else, and you want to hold the equation constant, other things have to move in these other ways to kind of hold the equation constant. So that's what we're doing here. The taxable value, we've already adjusted through our assessment rules and exemption changes, so there's no change there. So really, the lever, when we're talking about our tax rates here, in our current structure that we have, is the class share. That is the lever by which we adjust the rates for the classes. Okay, so how do we determine class share? Is this making sense so far? Is everyone still with me? Yes? Okay, good.
Well, I guess I wanted to go back to the previous slide. So now, just for the purposes of focusing on the class share,
yes,
you're saying that's the only lever. Clearly, in terms of class taxable value, the assessment rules and so on, those are levers involved there.
Yes.
So you're not dealing with those for this purpose.
No, because we would just, I mean, I'm presuming that we've kind of go through each of these steps and adjust the levers how we want, right? So
this is the lever you're talking about now.
yes. The class taxable value levers, those are the assessments and exemption rules and all those sorts of things, right? So for this purposes, yes, you can adjust those to effect here, but I'm presuming that you've already walked through and done that exercise already. So now we're stuck with, once you've set that and set that, the levy and the taxable value, this is your only lever. You could blow up the system as well and create a whole new structure, but within the current structure, I want you to understand sort of where the lever is in terms of the rates.
But to answer James, or to feed into that, you call it a lever. To me, it's like a binding constraint.
Yes.
Not a lever. You can't go past a certain, it's like a block, a cement block that's there that you can't.
The lever is how you want to determine those class shares, right? So how do you say class 1 should pay 15% or 20% or 10% of the overall levy?
Yes, but that gets, I think, to your next page.
Yes.
Right?
Yes.
And I consider it a binding constraint in that you can't do very much with it.
With the,
I mean, I'm seeing nods over there, so I'm clearly not completely crazy. Okay?
Binding because it's a state law matter? Is that why?
Yes, and because you start with the class shares of 1991. So you're always, everything here has been terribly incremental, where it's been able to move at all, and then you can't move it by more than 5%, so it's
But the point is, would we
Not
want to
fluid.
recommend doing something else
Yeah, it's
with
not
that
fluid.
rule?
Right,
Yeah,
but
do we want to continue to live by that rule?
The point is, under current law,
Yeah.
the commissioner is
Under-
constrained to only do it 5%
Under current
or
law,
less.
it's a binding constraint.
Yes.
Yeah.
Yes.
the lever is to change that law,
Yeah.
right?
Yeah, oh, thank you.
Yes.
So so these class shares, they are a function of three main points. I mean, again, I'm simplifying this greatly, but those class shares are based on the shares that each of those four classes paid in fiscal 1991. Why fiscal 1991? That's year zero of this system. That's when this system was set up under the current structure. So lever number one might be, is this the right year zero? Then the shares are updated to reflect market value changes. Not assessed value changes, market value changes. The idea here, and this is kind of where you get into the sort of, maybe what we perceive, at least on our little shop, the policy goal of the system is that there's an idea of fairness here that is maybe coming through, that the idea is that, all right, we had this, these are the shares that we're paying in 1991. We don't want to mess with that so much then, but let's just like let things sort of flow as the city flows. So if the value, if for example, going forward, if class one doubled in market value, say you built a bunch of new homes throughout the city on some vacant land that was, you know, if they that old plan of paving over the East River and becoming developable land, say it all becomes class one home, you want to allow the shares to adjust to reflect that you can get more of the levy from these new homes that were created. So that's sort of this idea of allowing the shares to change to based on market value. Now, obviously, if the market value increases and pushes up the class share and the assessments don't keep up, you're going to have some interesting consequences, which we'll get into in a second. So, but I want you to be aware that this is, it's basically the fiscal 1991 shares and the changes in just straight up market value. Now, there's also a limit on how much these shares can change. This is the class share cap. There has been some focus on this in the past. These shares, so if the shares cannot change more than increase by more than 5% over the prior year. That's not 5 basis points, that's 5% of the percentage there. So, for example, if a class had a 10% class share, a 5% increase would be, you can't go above 10.5% the next year. You can't go above 15%. So now the city has often asked the state to lower that class share, often with the intention of trying to help limit increases on class 1 and sometimes class 2 values. So, you know, you want to think back to those rates that you saw for class 1 and 2, be more extreme without those changes.
When you say in that sense that traditionally the city has asked the state to change it.
Yes.
When you say the city, I assume the city actually was the city council in that regard. This was not an executive branch driven decision usually.
So I will say that the city council is the one that passes a resolution asking the state to do this. As a matter of practicality, we often work with the city, or the administrative side, on this, and usually are often in agreement, actually always so far have been in agreement on what we are asking the state to do. So it's, while the city council does take the lead on this, it is, historically has been, at least since I have been here in my 10 years, been a joint effort.
It's part of a consensus budget.
Yes.
And I don't know whether what comes out has always been the mayor's side's first choice, but it's always been one they didn't feel that they opposed.
Okay. All right. So let's kind of apply this. I think what was helpful in this to understand sort of how this class share rate system works is to kind of apply a case study to it and see the.
I'm sorry, Emma.
Yes.
Can we just go back? Your very last bullet.
Yes.
The limit only applies
Oh,
to
yes.
changes due to market forces. You mean the limit of 5%?
Correct.
Can only be used to adjust for market forces, or you could adjust more than 5% for some other reason?
Right. So the class share calculations, which are appended to, so when the city council adopts the budget, we also affix the tax rates. We adopt 3 resolutions to do this. The first 2 are the determination of these class shares. Step 1, adjust the class shares for relative market value changes and applies that 5% cap, or whatever adjustment to that cap we have asked the state to give us. Then we again adjust those class shares with no cap to reflect physical changes. So the idea of, similar to the way the assessment caps and phase-ins only apply to changes due to market forces and not physical changes, the class share cap has that same sort of logic built in.
So you changed the class shares twice? Once for physical changes and once for...
Effectively. I mean, it's a 2-step process. It's not, I won't say necessarily twice, but it's a 2-step process to determine them.
Okay,
But the 5% only applies to the first step.
Exactly.
yeah, thank you.
But they're related, right? I mean, the physical change would affect the market value, presumably.
Yes, we back out, and I have to, there is a bit of parsing there in terms of what those changes are, and I think it's more that we adjust the class shares, apply the cap, and then adjust it to reflect the physical changes. So there's a...
Those changes become part of the base the following year,
I see.
right?
Okay.
All right, so hopefully this maybe helps us understand the sort of implications of this class, or how this class share system actually sort of operates. So again here, let me just say again, this is not anything that the City Council is considering. This is just something I, Emre Dev, kind of came up with out of the blue. I don't even know if this is a good idea or not. I'm just saying, let's use this as an example. So,
I don't even know what borough it's in.
yeah, I'm not advocating one way or another, so please no one write me letters or anything. The city and state, because we often need state law for these things, decide to enact a new tax program to encourage homeowners to add a second story to one-story single-family homes, right, to help with the housing crisis in the city. The tax program is there because we want to hold homeowners harmless. We don't want them to pay any more taxes because they take on this act. You know, they're going to invest this money to sort of increase the value of that property, or to increase the size of the property. That's going to result in an increase in market value, obviously. You're adding another story, some more square footage, property's more valuable. So we're going to give you a tax exemption to hold you harmless, right? So your assessment doesn't increase whatsoever. So as your market value increases, the idea is your taxable assessed value will not change. Now, let's assume that we've gone through all the assessment process for everything else, right? So all the market force changes, homes have gone up generally maybe 3% this year in value, and other physical changes. And let's just look at this, kind of isolate just this impact of this program, that with or without this program. So with this program, you have this new construction, and you're exempting that value. Without this program, you don't have that in construction, and then you're isolating just this impact here, right? So what happens? Let's go back to this formula. And go through how each item here on this formula is changed. Right, so we exempted any change in taxable value, right? So there's no change in class taxable value, the variable on the very right. There's no change in the levy, again, because we didn't change the taxable value. Remember, the levy is a function of the taxable value times the rate, and so there's no change in taxable value, no change in levy, no change in class taxable value. But we've increased the market value for class 1, right? So the class share for class 1 goes up. So now, on this equation on the right-hand side, I've increased the class share, but kept the levy and the taxable value the same. As a result, class 1's rate goes up. So now here you're giving an exemption to class 1, to a group of properties in class 1. But then the class share system is pushing up the rate for class 1. Now, I won't get into the exact mathematics of it, but that rate increase undoes some, but not all. You still get a good break on that property, but that exemption, that tax program is not working as efficiently as you might have thought to begin with. Moreover, there are other properties in Class 1 that were not part of this tax program, and their rate has now gone up as well. So now they're paying a slightly higher tax bill. Doesn't stop there. Class shares are kind of a share of the pie, right? So if Class 1 is paying 15%, everyone else is paying 85%. If you increase that 15% to 20% for Class 1, then everyone else's share is going to shrink proportionally. So we've increased Class 1's share. That means all the other classes see their share drop a little bit. And that means then, remember that the levy is not changing and the taxable values of the classes aren't changing, but their class share is smaller. That means their rate drops. Now take this and apply it to all the different tax programs, all the different assessment caps and rules, and you have a hard time sort of understanding what's moving what and what the actual implications of any tax exemption or assessment cap or limit might be. So, does that follow to people?
Can I put this a little boldly? It's a weird system because, if you think of the much discussed caps on the growth rates of assessments in Class 1, the principal beneficiaries are properties in Class 4 because the impact it has on rates. Or 421A might be making tax rates go up in Class 2 to the benefit of the other classes. It's a rather strange thing, at least I've always found it, and makes it very hard to think about what you're doing with policy.
So you can think about...
And what's causing that is the class share issue.
Right.
This whole binding of class shares, the whole fixedness, if that's the right word.
Right. The idea here is that you are... Right,
I'm sorry. Yeah. I used to know this stuff, and this is all bringing back horrible memories.
PTSD, okay.
I just want to make sure that I'm understanding it right, because this is the problem, right? This is a... Have I got it right? Maybe problem's the wrong word, maybe problem's a pejorative word, but this is the crux of what's causing the conundrum that you, Ray, were just trying to describe to us, right? Where something happens in one class to the detriment of the other class.
Or to the advantage.
Or to the advantage, in this case, to the advantage.
Isn't the real issue what the effect on effective tax rates is? Yes. Assuming we have a perfect measure or a good measure of effective tax rates. So how would your example, would it have any necessary effect on effective tax rates?
Yes, I think it depends on what level you're looking at this at, right? So if you think about a Class 1 home whose market value grows below the cap level, they're always at their 6% assessment ratio. Their value has been steady, or maybe going up a little bit, but they're assessed at the same ratio, about 6%. But the tax rate has been going up, so their effective tax rate actually has been going up. I want to be careful about how I say this because I know this can get very complex and confusing, but I think it does matter in terms of the metric, the level of analysis. I think if you look at Class 1 as a whole, yes, maybe the effective tax rate is, you have the caps, so you're suppressing assessed values, but the tax rate is equalizing that, and so you're raising the effective tax rate for Class 1 as a whole. But how that is distributed within the class might vary.
Yeah, I'm not convinced it necessarily has an effect one way or the other on effective tax rates. I understand that it'll affect the total classes share.
Right.
Because you have a policy, because we started with a policy change that induced a change in physical production in that area.
Right, so it's unclear exactly what all the machinations about what's causing Class 1's rate to go up, for example, but I would say you have, if Class 1's rate was 17% in fiscal 2010 or so, I forget exactly when that was, and now is about 20.5%. A property whose market value, whose assessed value is at the same relationship to market value, has seen their effective tax rate gone up.
I don't believe it changes effective tax rates even within classes because, but the big difference, it has, just think of it, the relative order of effective tax rate changes within classes, the rankings stay the same, but the absolute level is different. And I think it does change effective tax rates within classes. I think this is, let me give you the Ray hypothesis, which could be totally wrong. But my hypothesis is when we start looking at effective tax rates, we're going to find A, they probably do fit a pattern similar to what we expect. B, the differences are not as large as what we expect from first. Now that could be totally wrong, but that's the hypothesis I've been working on this. And this is one of the mechanisms, because it's taking back some of the gains that people are getting from some of these breaks, that might reduce some of the differences. But this could be, it's a hypothesis, not something well established in any shape, matter, or form.
I think the commissioner raised a very good point. Eventually, what is important is the effective tax rate and how the burden is distributed and what is the way to go about that, right? So if you look at the nominal tax rate for Class 1, it's higher than all of the others, but we would expect an effective tax rate for that class to be lower than others. And that also has to do with how you actually value property. So if you go by the assessed value or by the market value, right, that's partially by DOF is affected by the way that the law is written, and you need to use the comps and use comparable rents, and might not use sales value for all of them, right? So I guess this is something that the commission will have to look into. I mean, how do you actually determine or measure the effective tax rate, which is eventually the true tax policy measure of the burden, right?
But isn't this problem all because the class share is based on market value of the properties? So why can't you change that as one of the levers?
Right, so I don't want to kind of come across as sort of critiquing the class share system. There is a very clear goal here, and that's to make sure that the classes are tied together, and that there is not a desire. It makes it difficult to burden one class over another class, or to play favorites amongst the classes in a policy context. And so I think there is a rational reason there. The way it plays out can be confusing and maybe not, on the surface might not seem logical. So my purpose here is to not say one way or another if this is the right system or the wrong system, or does the system need adjustment or a whole new change. There's a logic here. There's an intent there was a lever activated when this system was set up to tie different classes together. That lever had consequences in terms of transparency, in terms of how the effective tax rate distribution might be amongst different properties. So there is a bit of this trade-off here too. You can have levers to do one thing, and it may cause negative consequences in other ways. Or unintended, I shouldn't say negative, but unintended consequences in other ways. And this is, I think, a very illustrative example of that idea.
Right, and actually, this is really valuable at least for me, because part of the issue that the commission has to grapple with is how to set up a set of recommendations to make a fairer, more transparent system when the underlying system was based on putting into statute what was then
an unfair system.
An unfair system.
Right. You start with an unfair basis, but then you adjust it in a fair way. Is the kind of
you could say it was trying to perpetuate the status quo, which had certain problems, and the rust.
That was the goal.
Exactly, that was the goal, and the more rust that has been put on that status quo, the clunkier this thing gets. right? And that's,
You could say, I mean, I would take another perspective though too. You could also argue that, right, there was an issue, and we'll get to this about the idea of transition, that there was concern about the transitional effects of going to a more equitable system, that there are equitable considerations of equity in transition, and the idea was like, well, we're stuck with this kind of unequal system, but let's not let it get worse. And that's what the market value adjustments are, is don't let it get worse. So there's from an equity perspective, there are bad parts and there are good parts in this
yes,
system.
and it's not an easy problem to solve, because there are property taxes everywhere, and every property tax system around the country tries to deal with exactly the issue of smoothing change over time for budget reasons, so that you have predictable revenue, and for planning purposes for households and businesses, so that they have some sense of what their ongoing tax liability is going to be. And whenever you do that, it creates horizontal equity problems, vertical equity problems, and these issues of opaqueness, less transparency.
Yes.
So we're going to have to balance those, and nobody, ideal may not be the exact result, right?
Right.
Satisfactory might do.
Moving on to the next step. So once you've figured out the rate, and you figured out your value, you figured out how you adjust that value, you come up with an initial bill for a type of property. And you may want to, again, another set of levers exists in adjusting that bill, that initial bill. This is similar in a lot of ways to exemptions. Often these are abatements is what we call them. And I'm not going to spend too much time on that. They work very similar in exemptions. Instead of reducing the taxable value, you reduce the final bill. You could think about it, if you ignore the class share system for a second, you could think that if I give an exemption of 10% or an abatement of 10%, they're both going to reduce my final bill by 10%, ignoring the rate system, right? So in some ways, they kind of operate similarly on the surface, and there could be a difference in where you might want to use one versus another in terms of how you target the intention of that program. And I'm going to use the example of J51. The J51 program exists to encourage rehabilitation of affordable multifamily residential property. It provides an exemption to any increase in value that rehabilitation might have, so that, again, similar to the case study I showed, it holds that property owner harmless for doing those renovations from a tax perspective, so that you get an exemption there. Then you also get an abatement, and that abatement helps reimburse you for the cost of doing that rehabilitation. So you can see that the exemption makes a bit more sense in terms of holding you harmless. You can think about in terms of the framing of that tax program, it makes sense to do one as an exemption and one as an abatement. Now, there is a very critical difference in how abatements and exemptions work in the current system. And that is all because, again, of the tax rate class share system. Abatements are applied after we've determined the tax rates. For that reason, in a revenue neutral setting, the abatement should not have an impact on the class rate.
So in the example we just went through a couple minutes ago, where the unintended consequence was the impact on class share, if it was done as an abatement versus an exemption, it wouldn't have that impact.
Yeah, you would. I guess I'm thinking maybe this is complicated a little bit here. I mean, if you wanted to keep it revenue neutral, you're going to have to raise the overall rate, and there's some distributive effects there. But in terms of the class share system, the abatements will not impact that system. I get this is complicated, and I think this is sort of might be a thought. If it's hard to understand, that might be a lesson in terms of how this lever is working and
Well,
where
we're here to be educated, so
Yeah.
continue.
But would the abatement be revenue neutral?
No, right.
The abatement's going to reduce
Yeah,
the levy.
It's a phase-in of the tax.
all the other things to raise your levy. Right.
So when I say revenue neutral, I'm looking at the levy aspect, right? So we have the tax revenue and we have the tax levy. This is a distinction in the budgeting world, and in the real, in the sense of how we budget. And so in a revenue neutral aspect, you want the revenue to stay the same. The levy minus various adjustments, including abatements, equals the city's revenue. So there is an impact here. That impact will be different, though, than how the exemptions work. Rather than affecting the class share or the class taxable value, you're affecting just the total levy. So yes, there will be impacts on rates in a revenue neutral setting, but it will act differently than exemptions. So the main thing, I don't want to spend too much time on thinking about how those differences exist, but the understanding is that an abatement has a different impact than an exemption on how the tax rates and the tax bills are determined, in a way that might not be self-evident at first. Part of the argument here is that as you think about these individual levers, it is not enough to say, well, we've reduced the assessed value on this property through this exemption, we're done. That saves that homeowner money. You have to work through this entire system, see the net result, and that will tell you what you've actually done.
Well, Emma, it may not affect these rates or the class share, but the question then becomes, how does it affect the overall revenue?
Yes.
Right,
So
like by how much?
it will reduce, and it's a bit more direct in terms of how much it reduces the revenue. And yes, you would want to raise the class rate, or the overall rate, actually, the total levy, to reflect that. And that does affect some of the rates, but in a more even basis. So you'd have to raise, for example, the rate by 2%, the overall rate by 2%, which would affect everyone's rate by 2% across the board.
So the abatement change won't change the relative market shares of the classes?
No.
So if you have to make it up in revenues, because of a revenue loss, it'll be whatever the current class share, everybody will pay that proportionate share of the change.
I guess I'm confused, but your example, yeah, think of it this way: you've raised the market, the total, you're adding to billable assessed value, right? When you put in the improvement, so at the same overall tax rate, you're adding to the overall levy, but you also are adding to the billable assessed value in class 1 by the same amount that you're increasing, at the same rate that you're increasing the share in 1.
Yes.
So the rate should not have to change unless I missed the math on it somewhat.
Right, so
But that's something you got to do the math. I'm having trouble wrapping my head around it.
if you,
But okay.
This gets at the complexity of this system and trying to kind of walk it through. But if you did this prior example of this second-story home, if you do it as an abatement instead of an exemption, let's walk through that, right? So now we're not exempting the increase in value, right? So that the assessed value goes up at the same percentage that the market value goes up because it's a physical improvement. So now my taxable value for that class goes up, the total levy goes up because you've increased the value, the taxable value in the city, and the market value is going up, so the class share goes up. So on the right side of this equation, the levy, the class share, and the taxable value all go up. And I believe the rates, I'm trying to think this through now. I don't have this quite right.
It has to go down if those three went up.
So we'll follow up with you next time, but suffice it to say, there are different results from
abatements and exemptions. Nice summary.
Something, different results.
You understand the difficulty now in setting tax policy in the city, right? So, and walking through all this.
Yes, okay.
All right. We were doing so well before. All right, so the last part is now you've applied your abatements, your reductions in bill. Now you come to the question of how you know, the tax is not just coming up with a number, but it's also collecting that tax, those tax dollars. And how you collect that has implications, particularly when you think about one of the charges of creating increasing transparency. How do we communicate this tax bill to the property owner? Many other taxes are reported by the taxpayer. This is one of those taxes that's mostly calculated by the taxing entity and given to the owner, and said, this is your tax bill, you can sort of contest it if you want, but we've calculated for you. So there are two areas of levers here. One is communication. How do we communicate how that bill is determined, which are often there's no list of property values. How do we allow them to communicate back to us? There's the formal tax commission appeals process. There's also Department of Finance's, they do take direct information from taxpayers saying you got this bit of information wrong. My square footage is not 2,000 square feet, but it's 1,500 square feet, for example. Then there's the idea of, you know, how much information is too much information, and I mean that from two different angles, at least. The first might be how much there's a bit of information overload that you can give to a property owner. Do you need to give them every little bit of detail? They're going to get overwhelmed, not know what you're talking about. There's also the aspect of, you know, you don't want to necessarily give out how they adjusted maybe RPIEs or how they've used those informations in their methodology. You don't want to necessarily create a roadmap. Remember when we were talking about valuation and that there are errors here? And there are errors, often when you're doing these statistical models, you have errors that on the plus side and on the negative side, right? And the hopes are that they kind of wash out a little bit. So you might have sort of, you know, overestimated the income in one area and underestimated the income in another area, and hopefully that nets out a positive income. If you start to give too much detail, a more savvy property owner might know how to attack that estimate in a way that only gets at the negative, you know, the things that are in their benefit, whereas a less savvy owner might not be able to do that. So there's a question about when do you give out too much information? If you want the focus to be on the net result, not necessarily the steps to get to that net result, I think. There's also the questions about how you collect that tax bill, how the tax bills are sent out. Most property owners in the city pay on a quarterly basis. The first tax bill is due July 1st, though there is a grace period to pay that. That creates a weird timing issue in terms of the tax rates. The city sets the tax rate, the council determines the tax rates as part of the budgeting process. As a result, those rates are often not available for billing purposes. So the first bill goes out using the prior year rates as a placeholder. Then, in January, the Department of Finance rebills as part of the regular quarterly billing at the new tax rate, and there's a slight adjustment. There might be issues around how you want to do that. Or do monthly payments make more sense for taxpayers? Does that adjust their ability to pay, and issues of fairness and equity? There's also the consideration that you are taking a capital value, something that isn't necessarily a liquid income stream, and asking the property owner to pay the tax in a liquid income stream. So there's a bit of sort of a conversion, there might be some conversion issues there, that you might have a property owner who is wealthy in terms of their home, but might be cash poor. So do you structure the payments to reflect that? That maybe you do a deferred payment structure, that, you know, that some of the taxes do become part of the ownership. You pay them when you transfer the title or sell the property, for example. There are some localities that do that kind of thing for senior homeowners, low-income senior homeowners. Any questions on that? So, we've gone through this whole process now. I want to leave a few parting thoughts about some considerations about using these levers. Hopefully kind of left you with the understanding that levers interact with each other, that you might do a lever at the classification phase or the value phase, And then the tax rate phase might have another set of levers that interacts with those original levers. So you have to be aware of how the levers might interact with each other and what the net result might be. Thinking about levers also, how clear are the levers in terms of their purpose? And how well can we measure their impact and understand that they're being effective in the way that they are intended? That applies for levers you are thinking about creating, but looking at the levers that are currently in place in the system. Again, targeting versus transparency. You could be like Ontario and create 36 property classes and subclasses, but that might have consequences for the transparency in terms of who pays what, and is everyone paying a fair share or not? Legal versus economic incidents. So, as a landlord, for example, I may get a tax bill from the city. I may be able to pass along some of that tax bill to my tenants through increases in rent. Now, the question is, and this is known as economic incidents, it's unclear how much of that tax bill I can pass along. It could be none of it, it could be all of it, it could be something in between. You know, if as a commercial property owner, you could think about, as a business owner, you might be able to pass along some of that increase in rent to your consumers through higher prices as well. So there's a question, just because the bill is in someone's name doesn't mean they're the ones who necessarily pay it at the end of the day from an economic perspective. The horizontal versus vertical equity that was discussed, that the idea of horizontal equity being that similarly situated property owners pay the same tax rate. So if you have two homes, they're next to each other, and they're both 2,000 square feet and 3 bedrooms, they should probably pay the same tax bill. That's the idea of horizontal. Vertical looks at more the ability to pay. So if one of those homeowners has a much higher income and other forms of wealth, maybe they should pay more than the other one. There's a bit of a trade-off there. Then the third one, this is a little bit kind of our thought onto this, is transitional. So maybe we think we have the system now, we have a new system we want to get to. How do you get from A to B? How do you reflect that maybe someone just bought a home or a property under the current structure with the current assumption of what the tax bill should be, and now we're going to change how that tax bill is calculated and what the impact would have impacted their value that they might have paid. And so there are some issues of transitional aspects as well. And the other part to think about is other taxes. And this comes in two flavors. One is real property in New York City is subject not just to the real property tax, but also there are the transfer taxes, the real property transfer tax. So if you sell property, you have to pay kind of like a sales tax on that. There are varying rates on that based on the use and the value of that transfer. There's a mortgage recording tax. So if you take out a mortgage to purchase that property, that is also taxed at varying rates. There's also the commercial rent tax, which is an excise tax, but relates to property. It's not paid by the property owner, it's paid by the tenant, the commercial tenant, applies in Manhattan, but it's also often grouped together around when thinking about other property-related taxes. So you might want to think about, when thinking about levers you're using here, how those other taxes might be impacting that property owner. The other aspect of taxes, other taxes, is thinking about the tax price. So if I bill you $100 in a property tax bill, current federal tax law allows you to deduct some of that tax on your income taxes, both corporate and personal. So now if I can deduct some of that, maybe that $100 bill actually ends up being only $80 to me, but $60 to someone else. So that's another consideration to have. I understand that those considerations can dramatically widen the scope of the Commission's work, but I think that's important to kind of contextualize this tax that exists not in a vacuum, but in conjunction with other taxes. So, any questions?
I'd like you to add the fact that James raised the issue, or we talked about the issue of tax-exempt property. So I think it would be useful if somewhere along the line we looked at water rates, because that user fee is, they are not exempt from that, and so we might want to look at some of that burden also in relation to the property tax. I know it's not, I know it's water use related, but it is directly related to property.
And used to be part of the property.
And used to be part of the property tax. And also, I think that to many people, the property tax is justified as a form of benefit taxation, the benefit principle of taxation. It's kind of weird because the worse value a property is, the less it pays and the more it's likely to draw on things like fire protection and all the rest, and police protection and whatever, but still, there is a benefit principle of taxation, and so I think if we try to lump some of those user fees that relate to property, looking at the overall burden, if we're trying to measure it, we ought to keep that in mind.
I think this this photograph you have is pretty apt in terms of the historical context of the property tax machinery that we're dealing with. There is an important lever, though, that I think you left out, although you certainly covered a lot of ground here. You could think in terms of a circuit breaker related to the city's personal income tax as a way to address some of the equity issues, and it just didn't fit neatly into your 6 boxes, but it's certainly something that we should be thinking about.
Right, I mean, I think that's, when you think about the exemptions and different levers, that you don't necessarily need to apply, those levers if they make the most sense in the property tax system, or they think about other taxes or a different system as well. So, we might think about the issues about zoning, for example, and how that might affect value, or the land value tax is often considered as a way to encourage development in the city. Is this the best place to enact that policy goal? So.
Other questions? Second, you gave a really good hypothetical example that you took us through about adding, and as you were doing that, I was thinking, well, there have been 2 recent examples of huge amounts of property being added, invented almost, or developed, just in Manhattan, where I live, and I'm sure that's true in other boroughs too. And I'm not aware, or it would be interesting to look at what all the development on the west side of Manhattan is, what Battery Park City did to the values there, and look a little at the changing development around the city, just because ultimately we're going to have to look at selling changes in this system to a legislature in Albany, and I think one of the strongest justifications and the reason we were put in existence is because of all the change that's happened in the property market and the development in this city. And it just isn't like the city in 1989 or 1979 with the Hellerstein decision, and it's not the same city. When I was finance commissioner in the early 90s, and the Grayson Commission looked at this also for property tax reform. So there have been all these interim, there are these stages of development that have happened in this city. It's got millions more people than it had, and it's got a lot different types of property that people didn't even envision.
Well, although the 2 largest examples you just mentioned are tax-exempt properties that they pay pilots rather than property taxes on, because of the nature of the properties.
And I want to thank Emma and the finance team. Well, me personally, I want to thank my team. But also, I think one of the words that came up and comes up in these presentations is this word incremental. And it's going to be really tough when we look at all the components on how you make changes and how there is a sense it has to be incremental because it impacts this area or that area. But part of it, and when I'm listening to you, Carol, it's the change in the city has been massive, but then the system, the changes have been incremental. And how we reconcile that will be a tough job, because when you do something in one area, it impacts the other and so forth. So I just, as I was processing all of this, I said, this sense of needing to do things in an incremental way, but at the same time, I think there has been this desire over many years that that's part of it, that it can't just be an incremental change. So it's just going to be a tough process.
Well, I mean, to some degree, this happened last time, right? And to my mind, at least, there's the issue of, before the commission, of what is a better system to have, and then there's a separate conversation of how to get there, and that's where that issue comes back.
So I want to add thanks to Imra and Ray and the entire team. Made all the more impressive by the fact that Imra is about to get married, and so we gave him something to, take his mind off of who sits next to whom, and gave him something a little more complicated there. So, so thank you to the team. But the idea behind the presentation was really to identify all of the different areas that we need to be thinking about, and the complicated ways in which they all interact. So, a couple of things to move the commission forward. One is that we will be holding the next meeting of the commission to hear from the corporation, from the law department, about the pending litigation. And so that session will be held in executive session, because we will be discussing that ongoing litigation. And Sharif, has that been scheduled, or we're still the September 20th? Okay. Okay. So we will get all of that information to the commission members, but that is the agenda for our next meeting. We will then be starting the public hearings. There are 5 public hearings, 1 in each borough. The schedule is posted on newyorkcity.gov. If you go for Advisory Commission on Tax Reform, you'll get the full list of where and when those public hearings are. We are trying to put out information to the public, working with the City Council Community Engagement, with the Mayor's Office of Community Engagement, and with obviously the City Council members and other local electeds to get information out to people. We're asking the public to focus in on some of these questions, and we've given some detail about the kinds of issues that we think the commission is particularly interested in hearing about, because we do anticipate that there will be active interest in these matters. We are asking people to limit their comments, limit their testimony to 3 minutes, but we are asking people also if they can submit them in writing so that the commission can review them in advance and ask questions, and those questions, of course, do not count in the 2 minutes, in the 3 minutes, excuse me. For the public hearings, we are telling people that while we will hear from the electeds in the area first in the public hearing, that otherwise it is on a first-come, first-served basis, so we will just take people as they sign up to testify. So those are some of the details. Any from the commission, any concerns about any of those details? We're basically trying to learn from both the public hearings held by the Mayor's Charter Revision Commission and the public hearings held by the City Planning Commission. So we're trying to learn from them. The Queens will, this is on the Advisory Commission for Tax Reform page on nyc.gov, but we did have to switch one of the meetings, one of the public hearings in Queens. It was scheduled for October 1st. It's now scheduled for October 3rd. The places for those, we are trying to find the most accessible, appropriate sized rooms, et cetera. So the places for those will be posted as we can post them. The first one is Staten Island and is
Michael Petrides Center, right?
the Michael Petrides Center. Yeah. So, but that's, that will all be posted on the website, so you can follow that there, okay? So any concerns about the structure of the hearings before we go into those for the commission, or any other concerns? People can submit their testimony in writing before, during, after the hearing. Obviously, because of the tight time limit, we encourage people to submit them before so that the commission can study them and ask better questions.
What will be the duration of the hearings?
Well, that depends on
How many
the
questions you
turnout.
ask?
Okay.
Right.
mean, how many
We
people sign
don't
up?
want,
Like city planning, as long as they're there, we'll hear them. Okay.
Although, not to overly burden the commission members, but we'll obviously ask that people stay as long as they can, but I think the two co-chairs expect to be stuck until they end.
we hope they won't go on as long as the Federer match last night, but but we do want to hear from everybody and give everybody an opportunity to be heard in whatever way they choose, either orally or in writing, if they want to submit in writing. And we will have we're trying to devise an easy-to-submit portal system. There was a question. So we're working that out, but that will all be posted, okay? Okay, so the other thing going forward for the commission is that we did talk about having what we regard as more sort of research hearings to dig deep into some of these questions. So we are both trying to reserve time for those. So the scheduling magicians who are in touch with you about reserving times will be bugging you about that. Mark and I thought that one of the first things that we should tackle is some of these questions about the valuation methods. And so we'd like feedback on that. We'd like feedback on what other things you think we should dig into. The tax incidence questions are certainly one that has come up. Questions about growth caps versus circuit breakers that James mentioned. Other kinds of transitional relief is something that we're looking into. So please, just let Mark and I know any ideas that you have about other things that we should be digging into, so that we can be reaching out to the researchers and other experts on those matters and scheduling those public research hearings. Okay? Anything else, Mark?
Just the draft research agenda.
And also we needed your comments on the kinds of data that we need to get, which we circulated to all of you. And so we need your comments on that. Okay? So any other questions, concerns from the commission? Hearing none, thank you again to the City Council Finance team, for the City Council for hosting us, for all of you all for attending, and to the commission. Are we having fun? Yes, Ken, we're modeling it after you. Elizabeth, nice to see you. Nice to see you too.
I like those questions on the classifications and possibly looking at different classifications.